Okay, in this week's podcast, our title is Navigating the Financial Aspects of Employee Health Benefits from the Employer's Perspective. And I'm so excited to introduce my dear friend, Matt DeGregorio. He's a partner for Lockton, and he's actually located in Fort Lauderdale. He acts as a conduit to all of Lockton's consulting and insurance practices, including employee benefits brokerage, 401k advisory, compensation consulting, property casualty, and financial professional lines brokerage. Prior to joining Lockton, Matt worked as a principal with Marsh and Mercer in Philadelphia and Fort Lauderdale. Matt also worked with Nationwide, a national leader in personal lines and small commercial insurance. Matt earned a bachelor's degree at Temple University with a major in risk management and benefits, with a minor in healthcare risk management. He also obtained an associate's degree in business administration at MCC College. He is actively involved as a board member, including Junior Achievement Development Committee and the Cystic Fibrosis Foundation. He is a licensed life, health, variable annuity, and accident, property, and casualty. Matt, thank you for being on the show, man. This is just awesome. I really appreciate you being here and us having the opportunity to share your wisdom bites.
I will do my best to overachieve. So appreciate the opportunity. And excited to have the conversation.
This is a critical process and decision-making endeavor for many, many companies, Matt. You and I have worked together in the past. You bring great insight and guidance. I can personally speak to that. Thank you for the years of your guidance on this topic. And I know companies struggle with this, Matt. So I'd like to get into it. Let's get into nuts and bolts. So, Matt, why is offering health benefits important for employers? Let's start with the 1,000-foot question.
Yeah, a good question, right? I mean, I'll start with, in the United States, obviously, after the Affordable Care Act, it's basically compulsory, right? So if you have more than 75 employees or so, technically it's 50, but anything over 50, by law, you have to offer it, right? And then taking that a step further, pre-ACA, which is still relevant today, it's a critical component to attracting and retaining employees for every business, right? So one, you kind of have to do it, but two, the employees demand it as well. So it's an unfortunate part of doing business in this country, I'll say, because it's a cost that keeps going up and something that's hard to manage.
Of course. And of course, way down the list, we get corporate tax deductions as well, right? So, this is a
silver lining.
I'm sorry?
Silver lining. That's a silver lining.
All right. So when we talk about enrollment, what health benefits are typically including in the enrollment period?
Yeah, generally it's, medical, pharmacy, vision, dental, some type of basic life that's usually employer paid, disability, short-term, long-term, and then you would generally have supplemental benefits or worksite benefits like accident, critical illness, things like that. Most people would think of them as sort of Aflac type policies that are voluntary for employee only.
Got it. And so, Matt, the process, whether it's a new program or it's, renewal, starts months before the enrollment date, typically 6 to 9 months, right? Depending on the complexity of the programs, right? So planning is key to this one, right? And so one of the major considerations, at least in my experience, is, having the optionality, right? There are different types of plans, different types of approaches. And the first one, as you know, I always ask you is, okay, Matt, give me the options between, fully insured and self-insured health plans, just contextually, right? What's the difference between the two, Matt?
Yeah, good question. So essentially, it's a funding mechanism for your medical program, right? So whether fully insured means that you're ceding off all the risk to the insurance company and you're paying a flat premium for that risk throughout the year, or self-insured meaning you're taking on the risk as the business, you're funding the claims through operating income and then obviously employee contributions that come into the business, versus again, you exchanging the risk, right? Think of it this way. The difference really is, do you pay for the claims in the year in which it happens, like you would in self-funded? If the claims happen this year, I pay for it. In fully insured, if you have a bad year, your renewal is going to be really bad. So you basically hedge to the following year where you're going to get a massive increase from your carrier versus paying for those claims in the operating cycle that they actually happen.
Got it. Okay. And so are there any other constructs outside of those two that we should know about?
Yeah, so those are on the extremes, right? And
Yes.
then they in the middle there are alternative like level funding, minimum premium, and there's a couple other sort of quasi self-insured, fully insured structures, all of which should be looked at, right? And there's no right or wrong answer, generally speaking. A lot of it has to do with the financials of the business. Self-insured, for example, if you have low margins or have cash flow issues, you should not consider self-funded, regardless of your size, right? And so as long as your margins are healthy, cash flow is healthy, you can consider self-funded or any of those quasi programs I just mentioned.
Got it. And so how should a company go about evaluating these different options, and perhaps just talk a little about the financial implications? You touched on a couple of them just now. Go a little bit deeper about, okay, we got maybe 3 or 4 options that Matt will bring to us. All right. Companies may not have, the superstar CFO, whoever, to help them evaluate, but at a grassroots level, how should companies go about evaluating these?
Yeah, I mean, obviously having a good advisor that knows what they're doing and has the analytical capability to look through the lens of the CFO, right, at the business.
Yeah.
Uh, like I started this conversation, you have to offer benefits to be competitive, but what that means for your business might be different than, ABC company down the road and how they view benefits as part of their total rewards package. So I tend to think of it as a dollar, right? If you think about salaries, bonuses, retirement, 401k benefits, how many pennies on the dollar are you willing to allocate towards that particular benefit? And what does it mean to your employees and what ROI you're getting? So I look at benefits as a whole through that lens. What makes the most sense for what I'm trying to accomplish, which is not offering benefits, it's attracting and retaining talent. If you have a population, and I'll just, make it up, that's maybe lower paid, for example, they'd rather be paid more hourly than they would getting a better benefit, right? So that should be part of the conversation. And then when you talk about just funding and structure, I like to think of that as, insurance companies as a business, right? Fully insured, it's the highest margin, right? So you're paying the highest possible cost, generally speaking, when you're ceding off all the risk to the insurance companies because they're trying to make a 15 to 20% margin on that versus you self-insuring it. You're playing with that margin, if you will, right? So 15 to 20% delta that you could potentially keep in house if you're willing to fund the claim. So I kind of went down 2 different paths there. I'm not 100% sure that exactly answered your question. So I can go back to it if you'd like me to, or keep going.
No, no, absolutely. We can keep going. We're going to go a little bit deeper. So, what's the pros and cons of each approach from an employer standpoint?
Yeah, I would say, look, once you get to 300 employees or so, you should start looking at self-funding. Or if you perform very well from a loss ratio perspective, right? If your claims are really strong, then you should be looking at ways to cut some of that margin out of that process. And so what I would say is, in general, you want to be thinking about self-funded if you have strong cash flow, if you have good margins, and you're 300 plus employees. You can look at it a little bit sooner. There's nothing wrong with that. But that all has to do with risk appetite. So at the end of the day, like I mentioned before, you can't run from your claims, and your claims are going to be 80 to 85% of your total cost annually.
Yep.
So whether you pay for them this year if you're self-funded or you pay for them next year if you're fully insured, the question is how much of that margin can I cut out, and then how many levers can I pull to control my cost in the self-funded world to make it advantageous for my business to keep the cost down as much as possible and or manage that trend year over year, which is much, much easier to do in the self-funded world than it is in the fully insured world. It's much harder to manage your costs year to year in the fully insured world because you're blended with other companies and you're dealing with the profitability of the insurance company.
What's the risk management you spoke about? Appetite for risk as an entrepreneur or fast growing business. What are the type of things that they've got to look in the mirror and try to consider from a risk management standpoint? If you go with a self-insured, you spoke about cash flow and so forth. What's the type of profile of company would be better suited for fully insured versus self-insured?
Yeah, it would say it's one, we talked about the size of the company. You want to
Yes.
have a certain number of employees that helps you manage the risk a little bit better. You want to have the good cash flow. You want to have good margins. But then you want to have infrastructure in place to manage it, right? So you have to have a strong HR team if they're going to be the ones managing the day-to-day administration, which is more involved on the self-insured side. You want to have a financial professional, whether it be the CFO, VP of finance, controller, depending on the size of the organization, that understands how to structure funding for self-funded, right? Meaning you're setting what some people would refer to as premium, but you're setting a funding level to pay for the claims. All of this is actuarially driven, right? But some companies don't budget appropriately, when they actually are going to set their premium equivalents, and they end up with shortfalls at the end of the year, not because they had bad claims necessarily, which could be one potential, but more likely they didn't fund it properly because they didn't set the financial parameters correctly at the onset of the year.
Now, if you've got unpredictability in your financial performance, right? As you quite rightly saying, I've been down this path a couple of times in my career, right? You may have unpredictable earnings for whatever reason. All right. Unpredictable cash flow streams, your planning cycles and planning methodologies may not be watertight, right? What's the downside? What's the downside of a self-insurance plan? And I may do all this stuff and find that, I'm not hitting my numbers, not hitting my cash flow, can't fund the claims. What's the consequence of that, Matt?
Well, can't funding claims, that's a big problem, right?
Yeah.
With that being said, right, let's just look at it in simplistic terms. If you're self-funded, you do an analysis that says your projected losses are X. And
Yep.
then simplistically, let's say the employer pays 80% of the cost, the employees take on 20% via their contribution. When you set that funding rate, you should be funding that at the 80% level, right? As the employer to cover your costs. So as long as you're setting that appropriately and you have stop loss and potentially aggregate stop loss, depending on the size of the business, you should be pretty insulated, right? Now, to your point, if the business suffers significantly from a revenue perspective, funding the claims could potentially be a challenge, but I'm not sure I've ever really seen that.
Okay.
Because you're typically funded pretty well in general for paying the claims. And there's a lag in claims over the year, right? The fourth quarter or whatever the fourth quarter of your plan year is, whether it's 1/1 or 4/1 or whatever, that's typically when employees are hitting the deductibles, meeting the out-of-pocket maximum. So the employer cost starts to go up in that self-funded environment because you're funding the claims. So there's generally a lag to build up the reserves to pay for those, towards the latter part of the year or cycle.
Now, some businesses would just prefer, I'll pay a little bit more, or I'll pay more, not a little bit more, but I'll pay more for the fully insured. And I've just got a consistent stream. I know how to budget it. I know what to do. It's someone else's headache. I'll pay a little bit more, in terms of admin fees and all the good stuff that's embedded there. Tell us a little bit more about the mindset that needs to be adopted between the two types of plans,
Yeah, look, fully insured, like you kind of said, look, it's set it and forget it for the most part, right?
Yep.
But it's the most margin, then the least control, right? So as a business owner, especially as a CFO, generally, and I'm stereotyping, you want control, right? You want to have some type of certainty on the outcome.
Yeah.
So in situations on the fully insured where either you perform poorly, meaning your loss ratio is above 82%, or maybe over 100%, meaning the employee, then you paid out $1. Let's say it's 120% loss ratio. You paid out $1 and the insurance company paid $1.20, which is a pretty good investment for you, pretty bad investment for the insurance company. And the insurance companies are in the business of making money. So they're going to take that 20%, tack it onto your premium for next year, plus add margin and so on and so forth, right? So the positive, again, is it's static. You know what you're paying for this year. But then the negative is you don't have much control the following year, and you're going to get whacked if you have a bad year anyway, right? And then you're also subject to that particular insurance company's cycle, whatever cycle they're in, and how their pool, which is basically all their other groups of similar size, and a fully insured, how they're performing, right? So in my mind, if I put myself in the CFO shoes or the business owner's shoes, fully insured has a lot less predictability over the long term than self-funding, where I can control more of my own destiny. Does that make sense?
It does. It makes perfect sense. Thank you for that. So you mentioned a couple of times, 80%, 85%. You mentioned once the loss ratio. So what are the key metrics? Let's dig down. Let's go a bit further now into the kind of finances of benefit plans. So what are the key metrics that we're talking about when evaluating employee health insurance?
Yeah, I mean, we use the word loss ratio a lot
Yeah.
already, which again, insurance companies are attempting to target the 82% loss ratio, right? So they want to make a 15 to 20% return. So they're targeting that. So anything below that is great for the insurance company, not so good for you as the employer, because meaning you paid out more money than you otherwise would have.
Yeah.
And then when the other metrics that you want to be mindful of, is more on the self-insurance side, is where are the buckets of dollars going out the door, and what can I do as the employer to control those costs, right? And so I mentioned before, claims are by far the largest bucket, right? So your claims are going to be upwards of 80 to 85% of your total cost of risk. Then you're going to have fixed costs that should be somewhere between 12 and 10% of the remaining component. And then within that total claims, there's going to be your pharmacy claims, which is a subset of your medical. So that's typically, I'll say 21%, 22% of your total cost of your total medical claims. And the unfortunate part is that pharmacy has been outpacing medical inflation. It's around 11 to 12% year over year. So it's the fastest growing component of your total cost in the medical and pharmacy realm, if you will.
So loss ratio basically, for simplifying all the way down to the basics, the cost of claims over the actual premium itself, right? And you're mentioning, maybe in the 80% range. So what can companies do to control the loss ratio?
That's a great question, right? So in the fully insured world, you can put in, I'll call them wellness programs, but really population health management is what works, right? And you can do that a couple of ways. One, you could do it through plan design. So most people would probably have heard of a high deductible health plan, or a CDHP, which essentially is the employee paying out of pocket first before a lot of the insurances kick in, for obviously for things that are more catastrophic in nature, right? Not like your daily office visits or preventative care, all that's covered up front. But what that does is it changes the mindset, right? So let's take, for example, let's say you had a PPO that had a $20 copay or a $50 specialist copay. All the employee sees is $20 or $50 in that environment, versus a high deductible health plan. Let's say they have to go see a specialist and that cost is $300. Well, they're going to pay that $300 out of pocket until they reach the copay or have the co-insurance or the out-of-pocket maximum, right? So the idea being is make employees think before they spend, right? And so a high deductible health plan accomplishes that because it's their money out of their pocket first. And there's all types of research and statistics and analytics that would tell you an employee will think when it's their money, but when it's the employer money, they don't really put much time or energy into where they go because they don't have to. And then so that sort of plan design. The other is through wellness programs or population health management programs, which should be structured in a way where the employee has to go to a doctor or get some type of blood drawn or other bodily fluids. And then there's metrics that come back that tell them, hey, here, your cholesterol is high, or your blood pressure is here and it really should be here for your age, or your body mass index says you're obese. And then it gives the employee an opportunity to start focusing on things to help get them to a place of better health, right? And that's a long-term process, but you can set up plan designs that reward them for doing that, or I hate to use the word punish because that's not the right word, but deters them from not doing it, right? So, and all of that could be accomplished through a well-designed, I like to say, population health management program. Others might say wellness. But you can accomplish those in those two ways is the easier way to do it.
Got it. Okay. And so give us a perspective, Matt. What's a good loss ratio? What's a better loss ratio? What's a great loss ratio? Just give us some perspective on benchmarks here.
Yeah, look, 82, 83, somewhere in that range. That's pretty good. As far as you're accomplishing what the insurance company wants you to accomplish, right? You're not in the red for them necessarily. If you're in the high 70s, low 80s, that's really good. If you're below 75, pushing 70, or even I've seen as low as 50 in some cases, that's fantastic, right? If you're fully insured. So what should happen if you're fully insured and you have a loss ratio in that realm, you should be getting cost decreases at renewal. What generally happens in my experience in evaluating other people's work, so not my work as an advisor, but seeing data from future clients, what generally happens is insurance companies will say, hey, I was going to give, we were at 12%, but we're going to give you a flat. And a lot of advisors will sell that to their client as, hey, we did a great job, your costs aren't going up. To me, that's, whenever I see flat, that is a massive red flag. That tells me that the insurance company's making a lot of money, the advisor's not doing their job. And the reason I say that is because if you're a 70% loss ratio and the insurance company's targeting 82, right? That's 12 points sitting on the board that they're keeping over and above their target, loss ratio. So that's increased profitability. Well, I should share in that as the employer and have my costs come down, right? Unfortunately, carriers are opportunistic, and some advisors aren't really as aggressive as they otherwise could be. So those are the good, great, and what you should be potentially be thinking of or be mindful of if you have those positive, strong loss ratios.
Got it. And in your experience, Matt, what are the companies doing differently that are the kind of great loss ratios, the sub 80%, 75? What do you think they're doing differently, whether it's wellness programs or whatever, in your world? What do you think? What advice would you give as to how companies could get there?
Look, sometimes it's luck, right?
Yes,
You just have a healthy population. And that could be a function of, let's say, in your industry, you have very young males, right? And your 70% of your population is, under the age of 30 and male, right? Typically, and again, I'm using statistics and analytics. I'm not stereotyping here. I'm just saying, in general, very healthy, not going to use the plan very much. They're not going to the doctors often. So your loss ratio by nature is going to be probably pretty good, right? I'll contrast that, and I'll stick with the males. I'll keep picking on them, right? Is if you're above the age of 50, right, and your population is 70% males, well, you're going to have serious problems, right? Because of all that stuff they didn't do in their 20s for prevention, as all that stuff starting to catch up to them, right? So they become more costly over time, right? So part of it's just the luck of the draw, what your demographics look like. The other part is going back to plan design, right? If you can engage the employees and make them think before they spend. And an easy example of that is you go to a specialist or a doctor and they say, hey, you need an MRI, go to this facility. If that facility is a hospital or hospital owned, that MRI is going to cost you $3,000 to $5,000, right? And that's a pretty wide range, but that's how big the range really is. Now, contrast that against going to a non-hospital owned facility, freestanding facility for the same MRI, same equipment, $300 to $500. If you can educate your employees on that and make them care, that benefits you as the employer, right? And this is self-funded or fully insured, doesn't matter. That's just an opportunity to control cost with your population. And then I think the other thing to do is, if you really understand your claims and you understand what's driving your cost, right? Because it'll be about, this is a high number, but 20% of your population is driving 80% of the total cost, right? And you could drill that down even more. The top 1% is typically costing 50 to 60% of your total cost of risk. Well, you should target that, right? Not, let's have a wellness program where everyone does a weight loss program, or, which I would call the sort of more less impactful things from an ROI perspective. But if you could say, hey, we have hypertension, diabetes, and musculoskeletal, there are top 3 issues that are driving 80+% of our costs. What are we going to do to target those, right? And there are all types of opportunity to put in point solutions and target those things through plan design to benefit the employee, which benefits the employer from a cost perspective. So I pause there. I threw a lot at you.
No, I think that's fantastic. And I do want to get to the point of, this is a balancing act. This is a financial series, so we're going to really drill in on the cost, but there is a cost benefit, right? I mean, clearly offering the right type of plans, you'll attract and retain great employees. I mean, that's clearly the concept and the theory here, right? So I do want to spend a little bit of time a bit later on about, there's another side. It's not just cost considerations, but I wanted to start on the cost consideration side first. You answered it perfectly well, Matt. So what are the other cost considerations? I mean, let's talk about components of health benefit plans. We talked about clearly the claims or loss ratio, so to speak. What else do we have to keep an eye out for?
So we'll switch to just a self-funded discussion, right? So
Yes.
you made the leap as an employer. We're going self-funded. So there's multiple different structures within that allow you as the employer to cut additional margin out, right? And so the traditional self-insured model is going to direct to what we would call as a BUCA, right? Blue Cross, United, Cigna, or Aetna, right? So real big insurance carriers that have very large, networks going directly to them and saying, we want to use you for administration. We want to use your pharmacy. We want to use your stop loss. So all that's what we would say is bundled, right? Now, a next step is to say, hey, we're going to carve out our pharmacy from the BUCA, the medical provider or medical carrier, I should say. We're going to carve that out. We're going to put it directly into a PBM, right? And by doing so, generally speaking, I can save costs, right? I can save somewhere between 10 to 20+% by just doing that, in theory, right? I could do the same thing with my stop loss. I can carve my stop loss out from the carrier and go somewhere else where I can get it more cost effective. So those are cost savings opportunities that you can do in the self-funded world. Or you could go even further, right? Saying, I'm not going to go to a BUCA. I'm going to go through a TPA or a third-party administrator who has access to the same networks. They have Blue Cross and, well, sometimes Blue Cross, but mostly United and Cigna and Aetna. They have direct access to their networks. But now I can carve out my stop loss, carve out my pharmacy. I can do different things in that flexible model, like adding bolt-on solutions like a Livongo, which is a diabetes specific solution that targets your diabetes populations, that helps get you an ROI and helps get them healthy and preventing them from having multiple different chronic illnesses, which is highly typical. That model is more complicated. It's not impossible. It's not rocket science, right? But it's a little bit more work for the employer, definitely more work for your advisor as your broker. And it's a little bit more sophisticated, right? And so maybe you don't go there right away, but maybe you get there eventually. But that model, I keep going to the right, is allowing the employer the most flexibility to pull as many levers as possible and to do things in a much more fluid environment with the lowest margin impact versus just being self-insured and everything's with the same carrier. And again, there's nothing wrong with that if it makes sense, right? I would submit that you almost always want to be looking at carving out pharmacy and stop loss, if nothing else, to leverage against the carrier to get better pricing terms and conditions.
Understood. Okay. And maybe I should have started off with this, Matt. Just generally in your experience, you've had couple of decades of experience. Generally, the ebbs and flows of the market. What are you expecting? I mean, insurance gets more expensive every year. All right, it increases every year. What would you say is an average increase in insurance costs? Let's just start with that. I mean, I'm coming in as an employer. It's a renewal or it's a brand new program I'm looking to. I've never had an insurance policy program before. What would I expect every single year in terms of an increase? Put in your claims experience aside for now, and then we'll hit that one afterwards. But what's a general increase I would expect?
Yeah, I mean, so we would turn to statistics like medical inflation, right?
Yes.
So, which is always, what our data would say is somewhere around 7%. What the carrier's data would say is, it's closer to 10 or 12. Just depends, right, on how you look at it. But it is so all over the place for companies that the average might be 7. But for example, and I saw this year, I've had clients this year fully insured that had 40+% renewal increases. So on some of which are on multi-million-dollar spends.
Yeah.
So if you again look at benefits like I do for my clients as a CFO or a business owner or a private equity owner, and say to myself, what cost of my business that I'm already spending $5 million on is going up by 40%?
Right.
The answer is nothing, right? There's nothing going up at that pace. So what am I doing to manage that is what I'd be asking myself as a business owner, and how am I going to prevent that going forward? Fortunately, in that particular situation that I mentioned, we actually found a way to get that down to 8%. But in general, I would tell you, if you're fully insured, you're going to expect anywhere from, 2% if you're lucky, to like 40%. And it's going to change every single year based off of your specific claims, how the carrier is doing, right? And what's going on in your population. Because you could have a couple bad claimants in your population that are ongoing, and that's going to impact your cost for next year.
100%.
On the self-insured side, it's different, right? Because the claims are the claims, and you're not paying the same margins, so your administration cost stays the same because it should stay the same for the most part every year for 2 or 3 years because you have guarantees in place. Your stop loss will go up maybe 5 to 20% depending on how you're performing. Your pharmacy should be going down from a total, not necessarily from a total cost perspective, but if your contract's negotiated correctly, you should be saving more money every year on a percentage basis relative to your total cost.
Okay. And so many business owners struggle to wrap their head around this one. So here's an important concept, Matt. It's how the medical costs, how do they show up on the P&L? All right. And so part of this is what you're saying is if we started from the beginning and says, okay, I go out to the market, I'm going to renew. All right. Matt's going to come to me as an advisor. And just my first question is just generally what you're seeing in the market. Matt's going to probably tell me between 5 and 10%. But specifically within my organization, I may have, claims and ratios, et cetera, that exceed that now, right? So I've got to deal with that. Now I start to say, well, okay, how much am I bearing as the employer? And how does that show up in my financial performance? And the PE guys are clearly very interested in this, right? And so over my travels, executives and entrepreneurs have kind of struggled with this point, right? There is what shows up in the P&L, Matt, is you've got a split between employers' costs and employees' costs. And we're going to talk a little bit about typical comp design and what ends up in the employees' kind of burden and what ends up in the employer side, right? But typically you'll have wage costs or, some type of labor cost, compensation costs. But on top of that, there's typically a factor, and this is the planning cycle, right? There's a factor on top of that with things like benefits. And the benefits is quite a broad bucket, right? So as part of the income statement, there are these costs now which will be on top of your wage costs, right? A factor such as the employer share of the benefits plans, right? Some companies will factor 10%, 15%, 20%, depending on where they are, right? But that's important to understand that the employee side is already factored in their wage costs. When we talk about what the additional cost is to the employer, it shows up as something over and above the wage cost.
Yeah.
Okay. Now let's talk about thinking about design now, Matt. Right? Let's talk about, how much should an employer take on? We've got a bucket. Let's use an example. You've got $100 in overall benefits costs, right? That's your entire plan. It's unreasonable estimation, but let's just use it for simplicity. You got $100, and now the pot's got to be allocated between how much do I levy the employee to take on and how much do I as the employer take on? What's that typical? Just give us benchmarks of what that kind of allocation begins to look like within reason.
Yeah, the basic benchmark is 80-20, right? 80% employer, 20% employee, right? Now that will range by industry. That'll range by tier, meaning employee only, employee plus dependents, employee plus spouse, or employee plus family. And over the years in that tier structure, many employers have had to make conscious decisions to say, hey, I have a responsibility to take care of my employee, right? So I'm going to put the vast majority of my contribution percent to the employee only, right? Maybe I'll put a good amount to employee plus dependents, but spouses, that's, you want them on our plan, you're going to pay the full differential in cost or something close to it to be on our plan, or a spousal exclusion saying, I'm sorry, your spouse is not even allowed on our plan, or if they have access to coverage elsewhere, they can't come on our plan. And a lot of that's cost control structure and or philosophical as an employer. Who are we here to take care of? Where are we going to put our dollar? How do we get that dollar to stretch further, right? That $100, as you mentioned, how do I get that $100 to last longer for me and get the benefit from my employees and my business? So there's many things there you think about. And then I take a step back and just say to employers, when I meet with a new, I call everyone a future client, right? Because you just never know who's going to do business with you eventually.
Yeah.
I always ask, well, how did you end up where you're at today? And typically the answer is, well, that's the way it was when I got here. Okay. Well, does it make sense for your business to be where you're at, right? Should you be doing what you're doing? And like I said, again, like there are some employees or some industries, they don't value the benefits, right? If I'm making $15 an hour and you're willing to pay me an extra dollar an hour, I would much rather take that than take benefits, right? Because benefits are going to be super costly and I'm probably not going to take them anyway. Or if I am taking them, it's because I'm scared or I'm sick and I need to take it. So in my mind, it's got to be more of a, take the blinders off. It's not just benefits. It's not just here's your renewal. It's what should we be doing for our employees? What do they value making my investments? Again, there's federal laws around this. Minimum, it's cost prohibitive when your wage is going up, wage and costs are going up 16%, right? And then your benefits are going up 10%. That's 26% increase in cost that you have to account for that maybe you weren't even potentially considering. And potentially, let's say 10% of that in the benefits isn't even of value to your employee. So why would I invest in that, right? As an example.
Absolutely. Absolutely. Okay. What are the other strategies? You mentioned a few. Any other strategies for controlling these costs from getting out of hand?
Yeah,
And
look,
yeah.
there's when you're fully insured, as I mentioned, that your opportunities are a little bit more limited. It's plan design and a wellness program. Maybe you can get a little bit of a quasi self-funded type plan. It still acts like a fully insured plan, but gives you some upside where you can share in profitability if you're performing very well. On the self-funded side, I mean, there's an opportunity to get very creative and to be much more involved as a business to help put what I would say the right funnels in place to capture those dollars that otherwise could be going out the door. So, and there's a whole bunch of them, right? But I'll start with on the pharmacy side, you should be considering carving out, right, your pharmacy, or at least marketing it as such. What you should not be is in a broker sponsored pharmacy collective. And what I mean by that is all the big brokers, the big publicly traded brokers, said to themselves, hey, we have millions of members that are a part of our clients. We will go to the PBMs on your behalf and negotiate a preferred contract with them. That's sometimes 1, 2, or 3 major PBMs. So think CVS, Express Scripts, so on, Optum. And then they have these proprietary contracts that they'll sell to their clients, right? The broker is doing that. And there are some savings in doing that, which is good. However, the reason the publicly traded brokers have designed these plans is because they make hundreds of millions of dollars on the back end. I say to myself, the money that they're making for their shareholders, it should be going to their clients. So yes, you should carve out or at least consider it, but you definitely should not go into a broker sponsored collective or any collective for that matter, if you can avoid it, because that you're leaving money on the table, right? Versus go direct to all the PBMs and not just the big 3 or 4. When we go out to market for PBMs, we're going to sometimes 15 different PBMs, right? And there's a whole plethora of different PBMs that have come up into this industry that have different saving structures. So definitely look at that, right? I would say definitely got to look at your pharmacy. Definitely consider moving out of a broker collective or moving away from a bundled approach, which sometimes can work with the carrier, sometimes not. Again, stop loss, same thing. If a broker has a coalition, you're going to leave money on the table going to the coalition because you're only looking at a small swath of carriers, right? Sometimes 1, 2, 3, or 4 stop loss carriers. When we go to market, we're looking at sometimes 20 different carriers, right? So you want an opportunity to look at as many insurance carriers as possible to give you the best pricing, right? The more people involved, more competition. So taking a step further, when you think about cost control, there are opportunities to plug in solutions. I'll give you an example. So if I were to say to you, I could reduce your elective surgery. So think knee surgery. So nothing that's emergent. Anything that your employees would be doing that's an elective surgery. Like I mentioned, knees, back, hips, other type surgeries that you elect to do. If I told you I can bring in a point solution that would drop that cost by 50%, and I will get you to the top, not provider, the top doctor, right? So not Mayo Clinic or Cleveland Clinic, the top doctor for that specific procedure in your specific area. I'm going to get you direct access to her or him at a 50% discount. I would assume most employers would say, that's genius. I want to do that, right?
Yeah.
Well, the challenge with that, and I would submit that every employer should do that. The challenge with that is some employers say, well, we don't want to force our employee to go to a certain doctor, right? We want them to have their own choice, right? But that then leaves money on the table. So there are other solutions you can add in like that surgery type solution that I mentioned. And you could back that up with targeted behavioral health management solutions. And then the other area, which is it's wholly unique to my firm, to Lockton, right? And is basically what we call clinical care management. So we have a solution that we embed for all our self-insured clients. It's 100% proprietary to us, where we look at that top 1% of claims that are typically 50 to 60+% of your total cost, right? And we're looking at that for a whole plethora of different things, right? Some of it is, hey, is this particular drug that's being prescribed even FDA approved for this particular ailment? In some cases it is, some cases it's not. Is it being billed appropriately, right? Or is this being misbilled? Or is the billing way outside of what we would say is normal parameters? And or opportunity to reappropriate care to find savings. So I'll give you an example. So a client of mine, not that far from here, had an employee going to the hospital twice a month for a self-injectable drug that was costing them $850,000 a year. Wow. So I'll say that again. A self-injectable drug, and they're going to a hospital twice a month, which is the most expensive facility you can go to for self-injectable drug. So we flagged this, reach out to the provider. The provider gave some pushback, naturally, because they're making tons of money on this particular situation. Eventually worked it through to where the employee would stay home. Now the employee doesn't have to go to the hospital twice a month. They can take the drug themselves at home. $100,000 total annual cost. Wow. So we saved that $750,000. Wow. Just by flagging something and moving it, right? And I have dozens and dozens of examples of that. And that's something that we do on behalf of our clients. And frankly, most of our conversation up to this point focused on the fixed costs, fully insured costs, self-funded costs, which is small. But if you can focus on that top 60%, you know, that 1% driving 60% or so of your total cost of risk, and I can find savings there, it's going to be way more impactful, right, than me, you know, messing around with the 15% of your total cost, which you should be doing anyway. You should be doing both, right? So to answer your question, long-winded, there are plenty of things you could be doing, and there's a lot of innovative things coming to market that all employers should be evaluating. Some of those are networks that are more narrow. Some of them are different bolt-on solutions, but it's never, in my opinion, should never be every year is the same as last year. If you're just doing this as an employer, well, our advisor comes out and then it's this cost, and then we do this, and then we whittle away the plan design. And that's not a strategy, that's a tactic, right? And when you think about the impact of this cost to your business as an employer, as either a founder or the CFO, it's an SG&A cost, right? Which impacts EBITDA. If you're thinking about selling to a private equity firm, it's all about EBITDA, right? And a multiple of that number. So for me, every dollar is a multiple. I don't know, let's just call it an average of 10 or 12, right? So $50,000 is not $50,000. It's $50,000 times 10 or times 12. And that's the way your advisor should be looking at cost in the benefit space, because it's impacting EBITDA, right? Which is impacting enterprise value overall.
Of course.
And as your costs go up and you don't do that today, it's much, much harder to go backwards, right? So your basis just keeps going higher and higher until you start doing the right things to bend that trend line and get it down. And there's opportunity to do that. You just have to be open-minded about looking at alternative strategies, and obviously have somebody to talk to you about it.
Absolutely. No, thank you for that. You mentioned stop loss insurance a couple of times. Matt, what's the role of stop loss insurance in my toolkit? How do I use that?
So that's your hedge against risk, right? So if you think about it, what you're buying is you basically say, An individual stop loss limit, I'll make it up, let's call it $150,000. So any claimant that goes over 150,000, you're then transferring the risk to the insurance company. That's the basic fundamentals of self-insurance, is you're capping your individual exposure per person across your entire group of your population, right? Now, there are some other ones that you could structure it differently, but that's essentially what you're doing. The question is what should your stop loss limit be, right? And most employers, if I were to ask the question, why are you at 150 or why are you at 175? Well, that's just what we were at last year. What you should be doing is looking at the same way you would look at like your hurdle rate, right? You should be saying to yourself as a business, what can we afford? What's the cost to transfer that risk? And is it beneficial to my business, right? So we would run a Monte Carlo analysis, which runs 10,000 simulations based off of your population and your claims data. And then we would be able to tell you, hey, if you bought stop loss, not at 150, but you bought it at 175 or 200, over the past 3 years, you would have saved $400,000, right? And how we can do that is just running that simulation, backing it up against the cost at those different breakpoints. We can tell you based off of how your claims are going to fluctuate and where they're going, what's the best financial structure for you. Now, some employers would say, I don't care. I don't want to take anything more than 150. We've done this for years. I'm very comfortable. Others would say, wait, you're telling me if I had done this, I would have saved X? Well, yes, I want to start doing that today because now I know I'm going to hopefully save Y, in the next 2 or 3 years just by implementing that small little tweak. So that's an example of stop loss, how it works. And then you should also have in your contract rate caps for renewals, and then also no new lasers at renewal.
Got it. What's the room to negotiate with insurance companies?
The key word you use, negotiation, right? Yeah. And everything in life is a negotiation, right? And so that's in my mind, the answer is it's there, right? And the room is significant, right? And part of that is based off of how sophisticated you are as an advisor. What tools and technologies do I have access to help me fight the financial fight with the insurance companies, right? What back-end capabilities do I have to help better articulate some of the things that they might be trying to come back at us with? And then, and this is going to be sad to say, but it's true, good old-fashioned relationships, right? Yep. What is my relationship like with the person or persons that I work with at the insurance companies day in and day out in my market, right? And a lot of advisors would say, hey, we're the biggest, we're the best, we have the most leverage with all the carriers. And having done this for 20 some years and having been with the biggest, and having said that before, and then also here where I'm at now, I would tell you is, if you think about an insurance company as a business, right? And you think about the underwriter and the salesperson in your market as an individual that's running a business that has mandates to grow it. Those advisors or brokers that are growing at a faster clip, that give them a better chance to meet their sales goals and targets, are going to get better preferential financial treatment for their clients because it's a business win-win, right? And that's not benefits, it's not carriers, it's just pure business common sense. If I help you hit your target every year for growth because we're growing more, you're going to give me better preferential treatment because it's the person that's feeding your business and helping you hit your targets, right? So relationship is huge in our space, right, wrong, or indifferent. If you can call in a favor when necessary, if you can leverage your relationship for the benefit of your client, which I try to do every single chance I get, that's a big differentiator. It's not just all, analytics. It's sometimes it's not all, quantitative, right? So some cases relationships really matter. And I can tell you for sure, I definitely leverage them when I can, right? And being fair to the people you're negotiating with, and being mindful of their goals and objectives as well.
Well, anytime I've worked with you, Matt, you've been tremendous on that one. So thank you for that over the years, To be complete on the cost side of the equation, to the best you can explain this and share, in terms of broker advisors, how should a business look at the cost of broker advisors? What are the different approaches? to the best you can share. All right.
Yeah.
Just let us know so they have complete information and going with open eyes into these relationships, and this approach.
Yeah, look, it's a great question, right? And the first thing I would say is you should always know what your advisor is making, right?
Yeah.
Regardless of your funding structure. You should definitely know it should be disclosed to you at least once a year. A lot of brokers do that. We do that, right? We tell you once a year, here's how much we're making, right? On the fully insured side, it's typically standard industry commissions or what's built in, right? And so it should be no more than 5% on the medical, and then ancillary. So think vision, dental, disability, all that's around 10%, plus or minus a point or two, depending on the carrier. And then voluntary, or the AFLAC policies, if you will, those commission percentages are all over the map. What employers should mandate for their broker is we want you to take flat commission, which is generally around 22%. You take flat commission, that's it. What a lot of brokers will do will take, it's called heaped commission, where they can get up to 80% of premium in the first year, and then it drops to 5% for every year after. The reason why I don't like that is because that incentivizes bad behavior, right? If I make 80% this year and it drops to 5% in year two, well, year three, I'm going to convince you to go to market, right? And then I'm going to convince you to change so I can then make more money. My opinion is it should be flat. So every employer that has voluntary, tell your broker, we want flat commission, right? Because it gets rid of that whole, potential conflict of interest. So that's on the fully insured side. If you're sizable, right? Meaning if you're spending $5+ million in fully insured commission, you should be having a conversation with your advisor on what percentage they're taking and what they're making. Like, so for me, on my fully insured groups, costs go up a lot over year. We talked about earlier, right? Somewhere between 0 and 15%. Well, just because my client might not be running well and we're negotiating the best renewal we can, whether it's 5 or 8 or whatever the number is, I don't necessarily need a raise or an increase in my compensation because their costs are going up. So I relook at my clients' projected revenue for next year every year at renewal. And if we're going to make more than what we made last year, assuming it's within, certain parameters, well, I'm going to reduce my commission on the medical to make sure I don't make more, right? Or if it's a larger group that keeps growing and growing and growing, your broker should be reducing their medical commission every single year. And that goes back to what we talked about earlier. It's an SG&A cost that impacts EBITDA. So if I can lower my compensation and that saves the employer money, right? Well, that's a direct impact to enterprise value. So even if it's 10 grand or 15 or 20 grand, right? Now on the self-insured side, you typically have a fee that's built into your contract with the carrier. That's on a per employee per month basis. There's generally commission built into the stop loss. Some brokers charge for pharmacy, either on a per employee per month basis or per script basis, which that should never be allowed. Or they charge a flat fee for you to have access to their pharmacy. And then again, the ancillary and all the other lines of coverage would have standard commission in it as well. I would say you should have a conversation with your advisor every year on what are you making versus what you're getting, right? It's hard to give a specific number, right? But I would say, I don't know. Once you're paying your advisor, over 200 grand or so on the fully insured side, depending on your size, you should be having a conversation, right? If you're self-insured and you are 500 employees and you're paying $200,000 or so, that's probably in the right ballpark, depending on the services they're giving you and all that stuff. If you're 1,000 employees, it doesn't just start doubling, right? It doesn't go from 200 to 400 for 1,000. Yeah. Maybe it should be 75 or 300. I think the point is you should be aware of it. You should be mindful of it. But at the end of the day, and having done this for so long, you can pretty much call any broker and on the phone and just say, hey, I'm paying X. Would you do it for cheaper? And the answer is some brokers would say yes, right? And that's just the nature of our industry. They'll say, yeah, sure, I'll take it. I'll do it for that amount. But, when you think about the broker costs as, depending on your size, 1% to 3% max of your total cost, beating up the broker to make, take 50 grand in savings isn't always the best option for you as the employer. Because if I can save you, and I do this all the time, I just saved the client $700,000 last week. They're not talking to me about my fees, but that particular client's growing. And I went back and said, hey, we have to reduce our fee. And we saved them another $75,000, right? They probably wouldn't even have cared, but I care, right? I care because I know what that means to the business. It's a multiple of that, right? So anyway, that's a long-winded answer to your compensation question, right? And here, I'll tell you, I'll offer this to your audience. Call me, tell me what you're paying, and I'll tell you if it's a good deal or not.
That's awesome. That's awesome, man. No, thank you. Thank you for that transparency. That's awesome. So we've gone down the cost considerations. We've still got to make a decision as an employer about what do we share with the employee, right? And that's always a very, very tough conversation, whether to your point is 60-40, 75-25, or 80-20, or whatever, right? Because the employer side shows up as, an additional cost, of course, right? And with, insurance increasing and depending on our own experience, that could be big numbers. Let's talk about the other side of the equation as to why we would say, okay, let's think about carrying more of the costs, all right, rather than the employee. Let's talk about your experience, Matt, about being able to articulate the benefit of, health plans to employees. What does it mean for the full kind of quote unquote HR cycle or people cycle, from hiring the right folks all the way through the system? Because this may not be down on a piece of paper or in a P&L statement, but there's some significant ROI by getting your health benefits right. If you're, in terms of attracting and retaining and, grading your employees, etc. Tell us a bit more about your experience. That's the hidden potential benefit that we don't see in a P&L statement,
Yeah, look, I mean, it goes back to attraction and retention, right? If your employees value the benefits that you're offering, right, and you have a good benefits package, you should be selling it to the employees, right? And all that starts with benchmarking. Know where you are at as an employer relative to your peers by industry, by geography, right? And then make a decision on where you want to be. Do you want to be in the top 25th, percentile, or 20? Do you want to be at the mean? Where do you as an organization want to be from a benefits value perspective, costs, and so on? And how does that help you recruit or retain, right? And if you're not retaining because of benefits, well, then you need to maybe think about investing in your benefits, right? If it's immaterial, right, then don't invest in it, right? That would be my general, kind of thought process. But you are investing in it. You are paying for it. So you should be able to articulate that as best you can to your employees from a communication perspective. And doing that, not just, hey, here's your renewal. And employees aren't stupid. They're going to see, hey, my cost went up from last year to this year, right? Even if it's minimum, they're going to see it because it's their paycheck. Well, explain to them the value of your benefits. Hey, did you know that our plan is at the 25th percentile compared to all of our peers? Did you know that we contribute more on a percentage basis than a lot of our competitors in this space? I'm making this up, assuming that's what the data tells you, right? And even if the data doesn't tell you that, well, what does it tell us, right? And what's positive? Communication is a key component to the overall value you get from a benefits package if you do it correctly. Unfortunately, most people don't do it correctly. And I'll give you an example. I had a client years ago that would pay 100% of the benefits costs. And this isn't that long ago. And the benefits plans are really, really good. And the employer paid 100% for every single tier, right? Which is extremely expensive. They made a decision to take it down to 95%. The benefits were still great. Employees lost their mind. They went bananas, right? From I didn't pay anything, now I have to pay 5%. Mind you, most people are paying 20+% of the total cost. So in that communication strategy, we use benchmarking. It's specific to their industry and said, by the way, did you know these top 3 employers, those employees are paying an average of 20% of the total cost. For you, that would be X, but you're at Y, right? And that's just the communication strategy. It's all about perception. Perception is reality. So I'm not sure if that accurately answers your question the way you were thinking about it, because it's not as easy as just saying, hey, you need to be here, here, or here. It's what's best for the business. And then whatever we're doing, let's go communicate that and the value of it to our employees and why it should matter to them, right? That way you're crafting the perception versus letting them craft the perception.
You've hit it perfectly, Matt, and that's exactly where we're going. So it's a great answer, because I know many companies, to your point, the majority probably fall short on that one, right? And so your overall point is absolutely companies need to do a really good job at benchmarking. Advisors can help that, whether it's industry specific or market, location, whatever, right? And being able to articulate that and communicate that effectively about the benefits of that. It helps with, as you say, with hiring and attracting the right employees and so forth. But I know for sure companies fall short of that, in terms of selling that benefit to employees.
Yeah. Well, look, I understand it. I get why. Like by the time you've been beaten up through the whole renewal process and you get to that phase, you're just like, we made a decision, we're done. I don't even want to think about it ever again. I get it. I mean, but look, it's like anything else you do or you invest in as an employer, regardless of what it is, right? Doesn't have to be for your employee. You want to understand the value, right? You want to make sure your team understands the value, right? When you make key investments in infrastructure or a system or whatever it is, right? There's a reason you're doing it, and you typically communicate the benefit, right, as to why. Well, do the same thing with your benefits because it's easily the top 5 line item in your balance sheet for sure, right?
Absolutely, man. So Matt, in terms of just the broad strokes timeline, let's talk about whether it's a new program or a renewal one, just the broad kind of strokes in terms of what is the process and the key milestones that businesses should kind of expect in the process, right? Including communication and enrollment at the end. But let's talk about that. Just give us the broad strokes.
Yeah, look, I think generally you should your advisor should be starting 6 months out, right? You're doing a renewal, you're doing a renewal, or excuse me, you're doing a pre-renewal strategy meeting or a stewardship strategy meeting of some kind 6 months in advance, regardless of you're fully insured or self-funded, or I don't care about the funding structure, right? You want to start 6 months in advance, develop your strategy based off of the data. And part of that should be me as your advisor wanting to learn about the business. What's going on in the business? What are you doing? What's the timetable for any acquisitions? What's the size of that percentage wise? What's it going to mean to your business? Or maybe you're selling off a portion, or your just organic growth is going crazy, right? Well, I need to know that, right? Because I want to help build that into our strategy, because that might tip the scales on looking at a solution that maybe we wouldn't have looked at. So 6 months out, you start that process. You should be setting the strategy at that time. And then you start deploying that strategy. If you are self-funded, you should be completely done with your renewal 4 months in advance, 3 to 4 months in advance, right? Other than your stop loss, because you can't lock that in until carrier has claims through a certain number of months. But generally speaking, you want to start very early, and you as the employer want to have time to make decisions. If you're fully insured, at least in Florida anyway, the carrier doesn't have to release the renewal until 60 days before the renewal. Now, you could ask for an early renewal, which sometimes is beneficial and sometimes not, depends on what's happening with the claims. So in that situation, your advisor shouldn't be waiting for the renewal to make a decision on what we should do, which unfortunately, many advisors will wait for the renewal, and then they're very reactive. Oh, this is really bad. They explain to the client, then they go to market. That condenses everything. Well, we should, at that renewal strategy, set this decision, renewal strategy meeting, are we going to market or are we not going to market? If we're going to market, well, let's go to market. I don't need the renewal to go to market. I might need the renewal to validate to the other carriers in the fully insured world. So, but if all the work is done leading into when I get the renewal, then it's done. We go in, have the conversation with the client, we make decisions, and then we start working towards open enrollment, communication campaigns, et cetera, right? No matter full insured or self-funded, definitely in the fully insured world, you should be done with open enrollment, everything, 30 days before your actual renewal date. So if you're a 1/1, end of November, that 30 days should be spent on administrative functions, right? Things to get the last things tidied up, right? If you're bleeding into that with your open enrollment, you have a problem, right? Because there's no reason for that. And that's not fair to the HR team. It's not fair to your employees to force enrollment on them, in a very rushed environment. And it's also going to cause problems post-renewal with ID cards and all that kind of stuff. So 6 months, but I would also say you should be meeting with your advisor quarterly, right? Because after the renewal, you should be doing a post-mortem and a stewardship, right? So, but at a minimum for the renewal should be 6 months.
Got it. Wonderful. Thank you for that, Matt. So what should a business consider before selecting an advisor?
It's a great question. For me, I would say everyone currently has an advisor, right? pretty much for the most part, unless you're a brand new business and you're just starting up a plan. Everyone has one. So I think every few years you should be reevaluating that relationship and whether you're getting from it what you should be or what you think you should be or not. And when you go out to look at advisor, my personal opinion, or at least what I ask for, is, hey, give me the data and I will validate why you should hire me, right? I will find opportunity, I'll find savings, compliance concerns. And if nothing else, I will validate that everything you're doing is perfect. Hey, there's nothing I can really do to improve this plan. I think make these two or three tweaks, but I'm not going to come in here and save you a ton of money. I'm not going to come in here and boil the earth. Everything you're doing looks pretty good. What I would tell you is, given that's my approach, 9.5 out of 10 times when I come in, I find tons of opportunity, right? It's not because, well, sometimes it's because their advisor might not be able to execute some of the things that we can do. And sometimes it's not because of who the broker is with, right? You could be with the largest publicly traded broker in the world, but your specific advisor is maybe not the strongest, so you're not getting the best consulting. So it's not specific to who your broker is, how big they are, how small they are. It's just more about, is your individual broker, the person you interact with, that team, how good are they? How strong are they, right? How invested in your business are they? Are they willing to do the work every single year, or do they get complacent, right? Unfortunately, human beings, complacency is a part of our fault, I would say, just a basic characteristic. So for me, every single year with all of my clients, I sit down with the team and say, hey, if we were going to take this from us, what would we do? How would someone else come in here and take this from us? And what that forces our team to do is start thinking outside the box for that client, right? What haven't we talked to them about? What haven't we done? What should we show them that maybe they passed on 2 or 3 years ago that we need to bring back to the table? If you're not constantly thinking that way, your advisor, no matter who they are, myself included, is doing a disservice to the business and to your employees, right? So you may have had your advisor for 20 years. I can virtually guarantee I can find opportunity in that particular situation because of the complacency component, right? So I would say that you should always at least bring one broker in every 3 or so years, give them some data and see if they can improve, right? And if nothing else, it just validates what you're currently doing is on par. And frankly, that's a pretty free, easy assessment for you as the employer. All you have to do is give them the data. And if that process starts with, hey, I don't have the data, that's red flag number one. Because if you don't have the data and your broker's not sharing it with you, you definitely are not getting a good shake at the deal, because you should have access to every piece of information. It should be at your fingertips.
What advice would you give for companies who are perhaps, because you're in the PE world, you do a lot of business in the private equity world, Matt, what advice would you give businesses who are kind of leading into a PE transaction?
That's a great question. So I would say, along the same lines of what I just said, 18 months, 24 months to 18 months before you would think you're going to go through a sale or a recap or whatever, you should do an analysis of your current program to find financial opportunity, right? Because every dollar I can find is going to be a multiple return for you as the owner or whoever the equity shareholders are. So if you give that advisor lead time, again, because you can only affect most of this change at your renewal. So that's why I said 18 to 24 months. You want to go through what I would call it's a data analysis or an opportunity assessment. Sometimes I call it a reverse due diligence, where I will come in and look at this business the way I would if a private equity firm hired me to find opportunity, right? Because when I'm looking at it from that perspective, I'm trying to find holes, gaps, deficiencies, compliance issues, anything I can use for my private equity client to use as an add back to get the purchase price down, or something we need to build in for escrow or in the reps and warranties plan. Like, that's how I'm looking at it. At the same time, I'm finding financial opportunity for them. So they build their deal thesis. Hey, I can save you $500,000 just by doing this. Once you bring this in-house, you bring me on as your advisor, I'm going to execute on that. Well, if I'm the business owner, I don't want any of that to come up during private equity diligence. I want to make sure everything's buttoned up and tight so no one can come back at me. And then I also want to find every dollar I possibly can find to get paid on it, right? Before I go give it to a private equity firm to get paid on it. So not that there's anything wrong with that for all my private equity clients. I'm not trying to, hurt your returns, but I think it would behoove business owners to think about that in anything that's an EBITDA impactful item, right? So anything that's P&C side, whatever, like because otherwise you're leaving dollars on the table. And I can guarantee you, the private equity firm, most of them are very, very good at finding that opportunity, and they will execute it post closing.
Absolutely. Brilliant advice, Matt. Thank you for that. So what's the biggest mistake businesses make as we're evaluating plans, we're going through the journey of instituting these plans? What do you think the biggest mistake companies make?
That's a great question. My mind goes to two different areas. One would be is not executing opportunity for the sake of we're just too busy, right? We're too busy to do that, right? I feel, because when you think about it, that's impactful not for this year, that's impactful for every year going forward, right? So that lost opportunity, not that you can't execute it the following year, the year after, it's really impactful for the business. I think the other side, right, wrong, or indifferent, goes back to what we've been talking about here the last few minutes, is if you aren't actively giving another advisor an opportunity to look at data and articulate opportunity for you, I can guarantee you're leaving money on the table, right? And maybe you bring in the wrong advisor and they can't find opportunity, or they don't articulate the right way, and that's possible. But in this world, I can't even tell you how many new deals I look at every single year, and every single one there's opportunity. There might be one or two. And I just did one actually a couple of weeks ago for someone actually. Brought me in and I said, look, this is not that bad. Like, I think I can do this and this, but I think your plan's pretty good, and I don't think there's a lot of savings here. And look, now right? And that CFO uses what they would say is, I trust but verify. CEO says this broker is great. They love the broker. I know you. I trust you. Take a look at the data. You tell me. And I said, look, I don't think they're doing that bad of a job, right? So, now the CFO feels good. He can validate it with his boss, and to me, that's the sign of a good advisor. Someone that can come in and tell you what's best for your business, not what's best for me. Sure, I want to earn new business and have a new client, but it'd be totally disingenuous for me to say I'm going to do something and add value and I can't, right? If it's not impactful for the business, then hey, let's just wait. Right? Maybe there's another opportunity down the road, right? If and when something goes wrong, call me, right? But I don't need to come in and make stuff up just to be hired. That would be, again, disingenuous. But like I said, it's very rare that I come in and say, oh, this is perfect. There's usually a lot of opportunity that's just sitting there waiting to be had, which is unfortunate, to your point about how much employers are spending. If there's that much opportunity sitting on the table every time I see something, that means there's opportunity for almost every organization if they were willing to take a look at it at some point.
Absolutely. And I endorse everything you just said as a dear friend and business partner, over the years, Matt. I mean, I've used you in that capacity. You've been tremendous about being completely transparent and honest about where the business is and the quality of the plans, etc. And always, I'm always going to put in a call to you at some point. All right, in my travels. So I appreciate that. All right. So Matt, what's your parting advice for evaluating the financial implications of employer-sponsored health benefit plans?
Well, I think I've already said it and beat that horse to death, right? So I would just add is it's never a lost cause. No matter how bad your claims are, there's always opportunity to help get your population on the right path. Again, that's going to take a little while, might be 2 years, might be 3, but if you deploy the right strategy today, you can get almost any population healthier. If you design the right plan, you can help protect the business while still offering something great for your employees. And if you're really creative, there's things that are out there these days that I can almost guarantee you've not been told about. Whether it's a good thing for your business or not, it's something that's worth looking at because you just never know.
And Matt, you've just hit it. You've hit another point about, the mission of this podcast series, right? We talk about, growing profitability and maximizing value for a greater good. We've talked about the cost implications. We talked about the financial part of this, but this is, in terms of making a healthier society, there is a greater good to that. All right. And we can't lose sight of that, amongst all of the kind of financial conversations we've been having. there is a part of this which is, elevating humanity, So I appreciate that, Matt, without a
100%.
doubt.
And I appreciate you and for all that you've ever done for me, both as a friend, as a client, and always giving me opportunity, when I get a chance to. So I appreciate that. And I appreciate you.
Thank you so much. Likewise, Matt. You're a dear friend. Love you, brother. Take care of yourself, okay? All
You
the
too.
best, Matt. Take
All
care.
right.
Bye-bye.